Price is always moving in swings. If you're trading on the 1 minute, you're going to have a swing. Okay. If you trade on the hourly, you are going to have a swing. If you trade on the daily, guess what? You will have a swing. Now, what's important to know about these swings is that there are parent swings and subordinate swings. So as intraday traders, when we have swings like this on the higher time frame, say the hourly, we will often see swings inside of swings. Okay, that's fine. But what does that mean? And how do we utilize that to our advantage? Now, I'm going to assume that the majority of us are intraday traders and we're using the lower time frame, the 1 minute or 5 minute, to take our entries. What we need to know is that there are parent swings to that 1 minute or 5 minute that we need to be aware of. And the reason being is that smart money, i.e. banks, have huge amounts of money that they have to deploy into the marketplace as they move price higher or lower. Okay, so what they'll often do is move price in swings to offset, accumulate more positions and offset those who are already in the position as price moves higher. Okay, because they can't have everybody just jumping in one point, taking a sweet little ride up to Profitville. Okay, so price moves on the higher time frame in swings just like it does on the lower time frame. The lower time frame is of no interest to banks. Okay, they are trading off the higher time frame. It's our job to get in sync and trade with the banks at these institutional reference points on the lower time frame. What we need to know is that we have this hourly price swing, and this is a bullish price swing with a low, higher high, higher low, higher high put in. Okay, but on the lower time frame, what we'll see is subordinate price swings to that hourly. Okay, so what we'll have is a former point, a high put in, a sweep of sell side, and this is a purge of previous buy side, and then we'll have bearish price action put in. Okay, then on the low, we'll have a low put in, which sweeps sell side. We'll then have a change in the state of delivery where we have a break in market structure, and then we will flip bullish. We'll then get to a institutional reference point on the higher time frame where price will look to reject and retrace. Okay, where we have a purge on buy side, we'll have a change in the state of delivery and market structure shift. Then we'll get down to a point of interest on the higher time frame where we'll then get a change in the state of delivery, market structure shift, where price then reverts higher. So inside of this price swing on the hourly, which is bullish, we have periods of internal range bearish price action. And with this being an hourly swing, this can be over a period of time on the lower time frame. What we need to understand is that there is parent and subordinate price swings. So these are subordinate to the parent, which is still bullish. Now, we'll get into understanding how we know this is bullish in a minute using protected lows and protected highs. But what at this point I just want to touch on is that we have subordinate price swings to the subordinate price swings. So this is an hourly, this is a 15, and I'm just going to use another one for the 1 minute. So on the 1 minute, we'll have higher highs put in, higher lows. We'll then have a high put in at this former point, which sweeps buy side. We'll have a change in state of delivery, market structure shift, return up into a premium or discount or fair value, something we talk about later in the series, where then we have a bearish profile put in with lower highs, lower lows. We'll then have a low put in on a 15-minute point of interest, where we then have a low violated. We then have a change in the state of delivery where we have the market structure shift. And then we'll have the same on the high, change the state of delivery, market structure shift, and so on and so forth. And we have these subordinate swings to the subordinate swing to the subordinate swing. But all of this is subordinate to the higher time frame parent swing, which is bullish. So in this example here, we have bullish price action, bullish, bearish, bullish, bearish, all in a bearish price swing as we get down to a higher time frame point of interest, which is down here. How do we get in sync with trading with the higher time frame? Well, this is how. And we'll talk about premium discount because that's fundamental to how price moves, and also pools of liquidity, which is ultimately what price is searching for on the higher time frame. But we'll talk about that later in the series. Today is purely on the foundations of market structure and how we can anticipate which direction price is moving next. Okay. What happens with these subordinate price swings and parent price swings is that we have protected highs and protected lows. What is a protected low? A protected low is a low which creates a high. So when a former high gets violated, the low which creates the high becomes a protected low. So this is our protected low. Okay, because this low created this high. So on the higher time frame, the hourly, we have a market structure shift. Unless this low violates this low, market profile is still bullish on the hourly. So when this low on the hourly creates this high, guess what? This becomes our protected low, okay? When it takes out this high. And price stays in that profile until we get a higher time frame change in the state of delivery. So for example, if this low violates this low, this then becomes our protected high when it violates this low, because this low created the new high. But when it was violated, this becomes our protected high. This then becomes our low. And what we'll then often see, daily premium objective, this is when we could anticipate price pulling back up into fair value or a premium, where we then see lower highs and lower lows put in. But as we now know that inside of this, we are then going to witness the same premise on the 15, where we have changes in the state of delivery and a break of market structure, where we then get lower lows, lower highs, lower lows, lower highs put in on the lower time frame, the subordinate price swing. So inside of this, we have mini pumps. We have little pump, 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 but all of this is in a bearish swing. Okay, and now we're just following price action on that hourly. Okay, so this high, which creates this low, this then becomes our protected high. Okay, so when this low gets taken out, this becomes our protected high. When this high takes out this low, this becomes our protected high. And we just follow price down. Now, what is important about this? Why is this interesting? Because guess what? With this being on the hourly, we can do exactly the same on the lower time frame. So when this high here put in this low, this was our protected high. So I'm just going to keep that white for now. So this was our low. This low did not violate this low. So this is still our protected high, right? But when price fails and takes out this high, we now have a change in state of delivery and a market structure shift. So what can we anticipate? We can anticipate price to pull back and start moving bullish, because this then becomes our protected low once it violated this high. So we're now looking for bullish market structure. So unless this low violates this low, we are bullish. It's very simple. So once this low creates a new high above this high, this becomes our protected low. This is our high. Same again. Once this low creates a new high, this is our low, this is our high. When this low puts in a new high, this is our low, this is our protected high. Okay, now what do we have on the high? Right, well, it's quite interesting because we have a low put in here, but this does not violate this high. So when it breaks this low, we've got a market structure shift where we're now anticipating bearish price. Okay, so this becomes our protected high once it violates this low. Okay, so this is now our low. Pull back into this high. Now it's at this point, it's interesting because now we have back in sync and being aware of the higher time frame, which is bullish still, because unless this breaks, we are still bullish. So in the next episode, we're going to touch on premium and discount and fair value and why that's important. But in this episode, I just want to talk about price swings and protected lows and highs. So when we get down to this low, this becomes our protected high. Once it violates, this becomes our protected low. This is our high, and we move price higher. And this is how we can get in sync, because guess what? If we know that this violation of this high, when this low created the new high, what can we anticipate? Well, on the lower time frame, we can anticipate a pullback, but this is our protected low. So we're not anticipating price to break this low. So when you get an understanding in premium and discount, which will be on the next episode, this is where we can look for exactly the same setup on a lower time frame, where we have a low which violates a former low, a break in market structure, a pullback, and then bullish price. And so it's here where we can start timing our entries, okay? And these can be 20 points, 30 points, 50 points, depending on what indice or Forex pair that you're trading. Same on these lows. Okay, so this low we're anticipating on the hourly for price to remain bullish is where we can anticipate a low on the lower time frame to break market structure, pull back, move higher, right? It's here where we can anticipate higher time frame breaks of market structure on the lower time frame. So we are anticipating a lower time frame change in the state of delivery and market structure to create a higher time frame break of market structure and change in state of delivery. The low that we had here and the high here, if we know that we are anticipating on the hourly that this is a institutional reference point where price is likely to move bullish, we can anticipate a 15-minute break of market structure on the 1 minute at this area. How we do that is by looking for exactly the same setup at these pivot points on the lower time frame. Depending on whether you're trading on the 1 minute, 5 minute, 15, 1 daily, at 1 hour, daily, weekly, monthly, you will always see this on the low, and it's this as follows. So on the low, you're going to see a low created, a high, a violation of a former low, a break of market structure, a return into fair value or a discount of a previous range, something we'll talk in the next episode, and then we'll have a change in the state of delivery where price starts moving higher. Okay, so it's this that we are looking at on the lows to be created. Okay, so this break of market structure, return to discount before price moves higher. Okay, and on the highs, we're looking for the opposite. We will have a protected low in, we'll have a high, we'll have a low put in, protected low, we'll have a high put in. Once we then get a purge of the buy side, the former high, and a break of the protected low, we can anticipate a change in state of delivery, return up into before price then moves bearish. Okay, that's what we're looking for on the highs. Okay, so exactly the same on the lows, albeit flipped. What we see here on the 15-minute, we can anticipate it to take place on the lower time frame before it takes place on the higher time frame. Okay, so we have it here. We have the low, the high, the low, and then we have price break the former high before price flips bullish. That is the exact profile that we're looking for. But on the lower time frame, guess what? We can anticipate and see this happen on the lower time frame. So we'll have a high, a low, a break of the former protected high on the 1 minute, return into a discount fair value or a point of origin before price moves higher. Okay, and we've now witnessed a subordinate price swing to a subordinate price swing to a parent price swing all around a higher time frame institutional reference point where we are looking for this profile to take place. So guess what? We can use this same protected low, protected high on the lower time frame. So this low, which created this high, becomes our protected low. I'm just going to make this red just for ease. So this is our 1 minute. Okay. So when this low creates a new high, this becomes our new low. This becomes our high. And let's just continue this. So when price comes back down, we are still bullish until this low breaks. This is our protected low on the 1 minute. We haven't even broken market structure on the 15-minute. All right, but we are anticipating a higher time frame break of market structure by using the same market structure profile, albeit on the lower time frame. Now we're looking for a bullish continuation on the 1 minute, right? Where we have a break of market structure and price has now moved bullish. Okay, so you can see that this low, once it violates this high, becomes our new protected low. Once it takes this high, once this high is created and put in, this low, once it creates this high, is our new protected low, and so on and so forth as we move higher. This would be like this. Okay. That's going to cover the first episode on market structure, parent and subordinate price swings. In the next episode, we're going to have a deeper look into this, into premium and discount and fair value, so we can build on our understanding. All right. If you found value, do consider smashing like and subscribe. And if you have any questions, do drop them in the comments below and I'll do my best to get back to them as quickly as possible. But until next time, trade safe, trade smart, and I'll see you in the next episode. Abosh!